Imagine a multi-ton cargo ship that somehow just accelerates like a customized high-performance Ferrari.
Right, which completely defies the laws of physics.
Exactly. Mass just doesn't move that way. But today we are looking at Amazon's Q2 2026 earnings, and I mean, their financial physics are doing exactly that.
It's honestly mind-bending when you look at the raw scale of it.
It really is. We're talking about a company generating hundreds of billions of dollars, a massive, mature conglomerate, and it is suddenly accelerating its growth at a pace that is usually reserved for, scrappy Silicon Valley startups.
Yeah, the kind of startups operating out of a garage, not a global logistics empire.
Right. So, welcome to the Deep Dive. For this one, we are acting as your talk tickers guides. Our mission today is to take Amazon's absolute blockbuster Q2 2026 earnings call and basically strip away the corporate speak.
Translate the Wall Street jargon into plain language.
Exactly. We want to figure out what this fundamentally means for you, the retail investor, who is either holding or considering this stock. So we are going to be data forward, we're going to translate the noise, and we will give you an opinionated, actionable bottom line.
Because the sheer scale of the acceleration we are seeing here, well, it requires a complete recalibration of how we model legacy tech giants.
It really breaks the traditional models, doesn't it?
Completely.
Yeah.
You just don't expect to see these kinds of growth percentages attached to numbers that literally start with 100 billion.
Yeah.
But before we get into the mechanics of how they're doing this, we need to anchor ourselves in the hard data from the release.
Let's jump straight into those headline numbers because they are staggering. Worldwide revenue came in at a massive $200.6 billion.
Which is up 20% year over year.
Right, up 20%. But the top line isn't even the most surprising part to me. You look at the operating income, and it hit $27.5 billion.
A 43% jump.
A 43% jump year over year. That is massive. And then you have the crown jewel of the entire operation, which is obviously AWS, Amazon Web Services.
Yeah, their numbers were just off the charts.
Their revenue hit $42.2 billion, up 36.7%. And they noted that officially makes AWS a $169 billion annualized run rate business.
And just so we are all on the same page for the listeners, run rate simply means if you take this exact quarter's revenue and project it out over the next 12 months, AWS alone is generating $169 billion a year.
Which is wild. If it were an independent company, it would be sitting in the top 25 of the Fortune 500 list, wedged right up there with companies like Chevron and AT&T.
And this represents their fifth straight quarter of acceleration, by the way.
Wait, fifth straight?
Yeah, fifth straight. We haven't seen this kind of consecutive quarter-over-quarter growth acceleration from AWS in 18 quarters. And that was back when the cloud division was literally less than half the size it is today.
That's just wow.
To move a $169 billion business at nearly 37% growth, I mean, that takes an unprecedented macroeconomic catalyst.
Okay, let's unpack this for a second because my skeptical retail investor alarm bells are ringing just a little bit here.
As they should be.
Right. When I see operating income jump by 43% to $27.5 billion in a single year, my default position is to assume someone in the accounting department is playing games.
It's natural to assume there's some financial engineering going on.
Exactly. On these earnings calls, you always have to look under the hood. Like, how much of this is actual structural business strength and how much of this is Wall Street accounting magic? Because I caught a massive asterisk in the CFO's prepared remarks.
Your skepticism is the exact right lens to apply here. Whenever a mature company posts a 43% bottom line jump, you have to audit the drivers. And there is a $1.2 billion asterisk embedded in that $27.5 billion operating income number.
A $1.2 billion asterisk is a pretty big deal.
It is. The CFO specifically categorized this $1.2 billion as, quote, reduced expenses, end quote, driven by one-time benefits. And it breaks down into two distinct $600 million tranches.
I want to dig into both of those because $1.2 billion is a lot of loose change to just find in the couch cushions. The first $600 million chunk was attributed to tariff-related refunds. Now, I understand the basics of that. Geopolitics shifts, rules change, they get a rebate on import duties, right?
Sort of, but it's a bit more nuanced in how it hits the balance sheet.
How so?
Well, Amazon actively tries to mitigate global tariffs by forward buying or prepositioning inventory across different international borders. And in many cases, they aren't even the importer of record, the third-party seller is.
Ah, okay, so the seller takes the hit.
Right. But for their first-party retail business, where they did pay the tariffs, and where those specific tariffs were subsequently rolled back or refunded by government action, well, they received a massive true-up check.
Okay, that makes sense.
And it's worth noting their stated policy on this. If they originally passed those specific tariff charges on to consumers at checkout, they are proactively issuing refunds directly to those shoppers' accounts.
Oh, that's interesting. So they aren't just pocketing the cash if the customer paid for it.
Exactly. But for the vast majority of items, Amazon actually absorbed the initial tariff cost to maintain their price competitiveness. So when the government refund clears, it drops straight to their bottom line as a recovery of a previous expense.
Got it. That part I can accept as a legitimate, albeit one-time, cash injection. But it's the second $600 million tranche that really caught my ear.
The derivative accounting.
Yes. The phrase they used on the call was derivative accounting on energy contracts. I mean, that sounds like the kind of weaponized jargon designed specifically to make analysts' eyes glaze over so they stop asking questions.
It certainly functions as a deterrent for casual listeners, I'll give you that. But decoding it reveals a really fascinating look at the hidden infrastructure of a modern tech giant.
Okay, decode it for us. What does that actually mean?
To understand this, we have to look at the physical reality of AWS. Cloud computing doesn't happen in the ether.
Right, there's no actual cloud.
Yeah, exactly. It happens in concrete data centers packed with servers. Yeah. And those data centers require a monstrous, mind-boggling amount of constant baseload electricity to power the chips and run the massive HVAC cooling systems.
Which has to cost a fortune.
It does. So to ensure they don't get crushed by sudden, volatile spikes in global energy markets, Amazon secures their electricity via massive, complex, long-term power purchase agreements, or PPAs.
Okay, so they are hedging their primary operational input cost.
Precisely.
It sounds like the exact same mechanism an airline uses when they buy long-term futures on jet fuel. You lock in a price today, so a war or supply chain shock tomorrow doesn't bankrupt your daily operations.
The mechanism is identical. Now, here is where the accounting rules come into play. Under standard Financial Accounting Standards Board rules, some of these complex energy agreements are legally classified as derivative.
Why derivative?
Because their value derives from the underlying fluctuating price of wholesale electricity. And Wall Street regulations require public companies to mark derivative contracts to their fair market value at the end of every single quarter.
Okay, wait. So they have to execute a mark-to-market valuation, even if Amazon has zero intention of ever selling that energy contract to someone else, because they obviously need the electricity to run their own servers.
That doesn't matter to the accountants. They still have to report what that contract is theoretically worth on the open market today.
That seems incredibly convoluted.
That is the core of it, though. Global energy prices fluctuated upward during the quarter. Because Amazon's Treasury Department was smart and locked in exceptionally low rates on a multi-year basis, those contracts became highly valuable.
Ah, I see.
On paper, those locked-in energy contracts are now worth $600 million more than they were at the end of Q1.
So the accounting rules force Amazon to record that $600 million as an unrealized gain.
Yes, which artificially lowers their reported operating expenses for the quarter, and that artificially boosts operating income.
So it's a pure one-time paper gain.
Entirely. Not a single actual dollar entered their bank account from this.
Wow. Which perfectly validates why retail investors need to strip that out of their models. I mean, if we pull out the $600 million tariff refund and we pull out the $600 million paper energy gain, we are subtracting $1.2 billion from that $27.5 billion operating income.
But honestly, even after applying that haircut, the remaining core operational margin is still explosive.
It really is. We are still looking at unprecedented profitability, specifically on the AWS side.
The underlying business efficiency is what actually matters here, because even completely stripping out the derivative gain, AWS posted a 39% operating margin.
39%?
Yep. That is an expansion of roughly 500 basis points or 5 percentage points year over year.
That's huge.
It is. To generate a 39% pure profit margin on a $169 billion revenue base is the kind of unit economics you usually only see in purely digital software as a service companies, not highly capital-intensive infrastructure businesses.
That margin profile is just a financial anomaly, which naturally forces us to ask, what on earth is driving that kind of explosive profitability in the cloud right now?
It's the multi-trillion-dollar question.
Because if we rewind just 24 months, the dominant Wall Street narrative was that cloud computing was maturing. The thesis was that most large enterprises had already finished their initial digital migrations from on-premise servers to the cloud, and growth was going to stabilize into the single digits.
Well, the entire macro narrative has been violently disrupted. The single overriding driver of this new growth curve is the monetization of artificial intelligence.
The AI boom.
Exactly. We have moved past the theoretical hype cycle of AI, and we have entered the commercial deployment phase. The AI monetization engine is officially online, and the data embedded in this earnings call proves it.
I want to isolate the specific data points they dropped regarding AI because they paint a very clear picture of demand. First, there is the AWS backlog. They reported a backlog of future contracted AWS commitments sitting at $496 billion.
Nearly $500 billion.
$500 billion in legally binding future revenue. And that backlog is growing at triple digits year over year. Beyond the backlog, they disclosed that their AI-specific revenue run rate has now surpassed $25 billion, which is also growing at triple digits.
They also noted that their custom silicon business, which is inextricably linked to their AI offerings, is independently sitting at a $25 billion run rate as well.
That's wild.
The sheer scale and velocity of the enterprise demand they are capturing is just staggering. I mean, it took AWS nearly a decade to reach a $25 billion run rate in traditional cloud services.
And their AI segment has achieved that scale in just a fraction of the time.
Right.
Here's where it gets really interesting for me, though. Every single tech company on the planet right now is hyping their AI capabilities. You literally cannot listen to an earnings call in any sector without a CEO dropping the phrase generative AI 50 times just to appease the analysts.
It's become a drinking game on Wall Street.
It has. And everyone is frantically building consumer-facing chatbots or specialized apps, hoping to strike it rich. But looking at Amazon's strategy, they are playing the consumer app lottery. Instead of gambling on which high-speed train will eventually win the race, Amazon is quietly, methodically buying up all the railroad tracks and the national power grid.
That is a much more accurate metaphor than the standard, selling pickaxes in a gold rush cliche we constantly hear.
Yeah, the pickaxe thing is overdone.
It is. Amazon is building the unavoidable base-level infrastructure that every other AI company must traverse. They have constructed a highly sophisticated, multi-layered AI stack.
Tell me more about this stack.
Well, this stack is deliberately designed to capture massive financial value, regardless of which specific AI model or consumer application ultimately dominates the market.
Okay, let's break that three-layer stack down in detail, because I think this is where a lot of retail investors get lost in the noise. We hear the acronym AI, and we immediately picture a chatbot writing a poem. But Amazon is monetizing this technology on a completely different industrial level. Let's start with the foundation, the hardware layer.
The bottom layer is the actual physical silicon required to make AI function. The current market narrative revolves almost entirely around NVIDIA.
NVIDIA is all anyone talks about.
Exactly. And to be clear, Amazon partners extensively with NVIDIA. They explicitly stated on the call that AWS is the most performant, most scalable place in the world to run NVIDIA's latest generation of GPUs.
Okay, so they're still heavily reliant on NVIDIA.
Yes, but relying solely on a third-party vendor for your most critical component destroys your pricing power and your margins. Amazon recognized this years ago, which is why they purchased a secretive chip design company called Annapurna Labs.
Annapurna Labs, right.
That acquisition allowed Amazon to build their own custom proprietary silicon.
And this is a crucial point for investors to grasp. Amazon isn't just renting out other people's computers anymore. They are designing the brains of the computers from the atomic level up. They detailed two specific lines of custom chips on the call, Graviton and Trainium.
Right. Graviton is their custom CPU, built on ARM architecture. It handles general-purpose cloud computing. And they announced that Graviton 5, which is their newest generation, is currently growing twice as fast as the previous generation.
Why is that?
Because it offers significantly better price-to-performance ratios for their customers compared to standard x86 chips from Intel or AMD. But the real AI powerhouse is Trainium.
Trainium.
Yeah. Trainium is a custom ASIC, an application-specific integrated circuit designed exclusively for the incredibly math-heavy, brute force process of training massive machine learning models.
And the demand for Trainium is where the numbers start to sound like literal science fiction.
Oh, absolutely.
They mentioned securing massive, multi-year, multi-gigawatt commitments from premier AI labs like Anthropic and OpenAI to use Trainium infrastructure. I mean, when a CFO uses the term multi-gigawatt to describe a customer contract, you realize we have completely left the realm of software subscriptions.
It's a whole different ballgame.
A gigawatt is the power output of a large nuclear reactor. We are talking about raw industrial scale energy and compute power being locked up for years.
And by offering proprietary chips like Trainium alongside NVIDIA GPUs, Amazon provides its customers with a choice.
How does that play out for the customer?
Well, if a customer wants the absolute cutting-edge general-purpose AI compute, they can pay a premium for NVIDIA instances. But if a massive AI lab wants to train a model and needs to shave 30% off their infrastructure bill, Amazon can route them to Trainium.
And because Amazon owns the intellectual property for Trainium, they capture the entire margin profile of that chip, rather than passing a massive cut to a third-party designer like NVIDIA.
Exactly. That is layer one. Layer two sits directly on top of that hardware, which is the platform layer, centered around a service called Amazon Bedrock.
Bedrock feels like the strategic linchpin of their entire AI philosophy.
It really is.
An analyst on the call actually pressed CEO Andy Jassy on this. The prevailing narrative is that to win the AI wars, a company needs to own the single, dominant frontier model, the smartest, most capable AI brain on the market, like a ChatGPT.
Right.
So the analyst essentially asked, does Amazon need its own version of GPT-4 to survive?
And Jassy's response was incredibly revealing. He essentially said, no, we don't strictly need one to win the enterprise market, but we are aggressively building our own frontier models anyway, primarily to control our internal cost structures.
Which is a very Amazon answer.
Right. But the genius of Amazon's external strategy lies in Bedrock. Bedrock is a managed service that acts like a massive, secure buffet of AI models.
Buffet. I like that.
Instead of forcing a corporate customer to lock themselves into one specific AI ecosystem, Bedrock offers API access to all the leading models. You've got Anthropic's Claude, Meta's open source Llama models, Mistral, and Amazon's own Titan models all in one place.
I would argue that model agnosticism is the only viable strategy for enterprise software right now. I mean, if you were the chief information officer of a Fortune 500 company, the absolute last thing you want is vendor lock-in on a technology that is evolving this rapidly.
Chief information officers are terrified of betting their entire corporate infrastructure on a model that might be obsolete in 6 months.
Exactly. The frontier models are constantly leapfrogging each other in capabilities and pricing.
And an enterprise wants the flexibility to route different internal tasks to different models. They might want to use a massive, expensive model for highly complex legal reasoning, but route simple customer service chatbots to a cheaper, smaller, open source model.
Right. You don't need a supercomputer to process a basic return policy question.
Exactly. Bedrock allows them to seamlessly orchestrate that routing within a single, unified environment. More importantly, it does this securely.
Security is huge.
Huge. Bedrock ensures that a corporation's proprietary sensitive data is never used to train the public versions of these models. It provides the infrastructure for choice and security, which is exactly what the enterprise market demands.
So we have the custom silicon hardware at the bottom and the Bedrock routing platform in the middle. What is the third layer?
The top layer is the application layer. This is where the abstract computing power and the models are translated into tangible, everyday tools that actually generate return on investment for a regular office worker or a software developer.
And Amazon highlighted two massive enterprise tools operating at this layer, right? And they are gaining serious commercial traction. The first is Amazon Q.
Yes.
The description of Amazon Q in the call was fascinating because they went out of their way to differentiate it from a standard consumer chatbot. They consistently referred to it as an AI agent.
The distinction there is vital.
Explain the difference.
A chatbot just answers questions. An agent actually takes autonomous action across your corporate software suite. They describe Q integrating deeply into workflows across Slack, Jira, Salesforce, and ServiceNow.
So it's not just talking, it's doing.
Right, and the integration is the key value proposition. Amazon Q respects and enforces existing corporate identity and access management controls.
Oh, that's critical.
Extremely. When an employee asks Q a question, it dynamically checks their security clearance and only synthesizes answers based on data they are legally allowed to see.
So the intern can't ask Q what the CEO's salary is.
Exactly. But the agentic part is where the productivity gains happen. An employee can ask Q in Slack to synthesize a summary of a project status based on 50 different Jira tickets, draft an update email to the client, and automatically update the corresponding CRM record in Salesforce.
Wow. So it functions as a highly secure, autonomous corporate assistant.
Yes, and they cited major enterprise deployments with customers like 3M, BMW, and Southwest Airlines, proving this isn't just a beta test. It's driving real business value today.
But the second tool they highlighted at the application layer, AWS Continuum, feels like an even bigger potential revenue driver, simply because of the specific problem it solves.
I agree. Continuum addresses the single biggest bottleneck in enterprise technology, which is cybersecurity.
Yeah.
If you sit down with any Fortune 500 board of directors right now, their primary concern regarding AI isn't about how many emails it can draft, it's about the security perimeter.
Right, because hackers are using AI too.
Exactly. As AI models become more sophisticated, malicious actors are using them to find zero-day vulnerabilities in corporate code bases at an unprecedented speed. AWS Continuum is designed to be an automated defense mechanism against that exact threat.
Let's break down exactly how Continuum works, because it's fundamentally different from the legacy security software we're used to. Historically, static code analysis tools would scan a company's code base and spit out a spreadsheet with 1,000 potential vulnerabilities.
And 99% of them were false positives.
Exactly, and it completely overwhelmed the human security engineers who had to investigate them manually.
Continuum solves the false positive problem by acting as an intelligent agent. When a software developer commits a new piece of code, Continuum doesn't just scan the syntax. It uses advanced frontier models to reason through the context of the entire application.
It reasons through it.
Yes. It asks, is this specific piece of code actually deployed in a live environment? Is it part of a critical production path that touches customer data? What is the actual real-world blast radius if this vulnerability is exploited?
And the technical mechanism it uses to validate the threat is brilliant. It takes the flagged code, dynamically spins up a secure sandbox environment on AWS, and literally attempts to autonomously exploit the vulnerability itself.
Yes.
It acts as an internal automated red team. I geek out over that.
It's incredible. By actually attempting the exploit in a sandbox, it definitively separates the false positives from the critical threats.
But it doesn't stop at alerting the security team, does it?
No, it doesn't. Once it confirms a vulnerability, it autonomously writes the necessary patch to fix the code, tests the patch in the sandbox to ensure it doesn't break the rest of the application, and then submits the finished, secured code back to the human developer for final approval.
It is an AI cybersecurity team that works 204/7. When you understand the mechanic of how much time and money that saves an engineering department, you immediately realize why enterprises are willing to pay a massive premium for it, and why running Continuum requires so much underlying AWS compute power.
Which provides the perfect transition into how CEO Andy Jassy conceptualizes the broader market demand for AI right now. He introduced this framework on the call that he called the barbell analogy.
The barbell analogy. I loved this part.
If you want to understand the thesis for Amazon's future growth, you really have to grasp this concept.
Break it down for us.
The barbell framework perfectly illustrates the current maturity curve of the AI market. Picture a standard weightlifting barbell. On the far left side, you have a massive, dense cluster of weights. This represents the AI labs, companies like OpenAI, Anthropic, and Google DeepMind.
The heavy hitters.
Right. Their demand profile is incredibly heavy and highly concentrated. They are consuming unbelievable amounts of raw compute power, specifically to train the next generation of foundational models.
And training is brutal on compute.
Very. This training phase requires tens of thousands of specialized chips running at full capacity for months at a time. It's a massive capital sink, but it represents a huge chunk of current AI revenue.
Okay, that's the training side of the barbell. On the far right side of the barbell, you have another cluster of weights. This represents the immediate, highly specialized application of AI by forward-thinking enterprises. These are companies rapidly deploying tools like Amazon Q for customer service automation, or utilizing coding assistants. Jassy actually specifically called out their internal coding assistant, Kiro, noting it is currently operating at a 50% more cost-effective rate than competing products on the market. So you have heavy training on the left and rapid specialized task automation on the right.
But Jassy argued that the real generational opportunity lies in the bar itself.
The bar connecting the weights.
Yes, the massive, thick steel bar connecting the two weights. This middle section represents the entirety of traditional legacy enterprise workloads. It's crucial to remember a statistic that Jassy emphasized, which is that despite 2 decades of cloud computing growth, approximately 85% of global enterprise IT spend is still allocated to on-premises data centers.
I have to pause you there because that statistic always breaks my brain.
It's shocking, isn't it?
85%. We assume everything is in the cloud, but 85% of IT is still sitting in basement server rooms.
Yep. The vast majority of the world's corporate computing has not even migrated to the cloud yet.
The pure migration of those legacy workloads to the cloud over the next 10 to 20 years is already a multi-decade trillion-dollar tailwind for AWS. But now you are injecting the AI catalyst into that migration.
Exactly. As these massive traditional corporations finally migrate their core databases and applications to the cloud, they aren't just going to lift and shift their old software.
Right. Why would they?
They are going to fundamentally rebuild their operations to infuse AI inference into every single business process. And inference is the key term here.
Define inference for the listeners.
Training a model happens once on the left side of the barbell. But inference, the act of querying the model, asking it to make a decision, running a transaction through it that happens millions of times a day, forever.
Right.
That middle section of the barbell hasn't even begun to fully adopt AI inference at scale yet. When they do, the compute demand will dwarf the current training demand.
This highlights the ultimate compounding flywheel of the AWS business model. Because growth in AI doesn't just sell more AI chips, it actually drives exponential growth in their traditional core non-AI cloud services.
How so?
Well, because when an enterprise deploys an AI agent to manage their supply chain, that agent doesn't operate in a vacuum. It requires a massive structured database to pull historical information from. It needs secure object storage to house the documents it generates. It needs standard CPU compute to execute basic logical routing.
It pulls everything else up with it.
Exactly. You cannot run advanced AI applications without consuming massive amounts of the foundational high-margin cloud infrastructure that AWS built its empire on in the first place.
It creates an inescapable gravity well for enterprise IT budgets. Once a company starts utilizing AWS for AI, they are fundamentally locked into consuming the rest of the AWS ecosystem to support it.
Okay, so the cloud division is undeniably printing money. The margins are historically high, and the multi-layered AI strategy provides a clear runway for decades of growth. But, we cannot analyze Amazon solely as a digital infrastructure company.
Right, they still deliver packages.
Exactly, because at the end of the day, Amazon is also the company that drops physical cardboard boxes on our porches every other afternoon. This brings us to the physical, retail, and logistics side of the business. And I want to make it clear, these two halves of Amazon, the digital cloud and the physical warehouses, they do not exist in isolated silos.
Oh, not at all. They are deeply symbiotic.
Right.
The logistics engine that powers their physical retail dominance is heavily reliant on the advanced AI and compute capabilities developed by AWS. The optimization algorithms that route a package across the country, the computer vision systems running on the warehouse floor, they're all powered by the cloud.
Let's dig into the numbers for the North America segment, which encompasses the bulk of their physical retail and logistics operations. Operating income for North America hit $9.1 billion, representing a 7.9% operating margin.
Which is very strong.
Now, for an e-commerce retail business dealing with physical inventory and massive shipping costs, a near 8% operating margin is incredibly healthy. But I have to push back on this narrative.
Oh, where do you see the contradiction in their retail strategy?
Well, when you look closely at what specific product categories they're aggressively expanding, the margin profile feels entirely contradictory. Look at the two specific growth areas management chose to highlight on the call.
Haul and groceries.
Yes. First, they hyped the expansion of Amazon Haul. This is their ultra-low price storefront designed specifically to combat the rise of discount overseas retailers like Temu and Shein. They noted they have expanded Haul by 20x since its launch, now offering over 6 million individual items priced under $10. Second, they heavily highlighted their push into groceries, specifically same-day perishables. They noted that fresh groceries now make up 6 of their top 20 best-selling items overall, and these specific orders drive 3x more units per transaction than standard orders.
So you are questioning the fundamental unit economics of those specific categories?
Absolutely. I mean, anyone who has studied the history of retail knows that selling a $4 plastic spatula or delivering a bunch of temperature-sensitive bananas to someone's front door in 2 hours are notorious margin killers.
They are notoriously difficult.
The sheer cost of the cardboard box, the labor to pack it, and the last-mile delivery driver almost always exceeds the profit margin embedded in ultra-cheap goods. And groceries even worse.
Because of the cold chain logistics.
Right. It requires highly capital-intensive cold chain logistics refrigerated warehouses and trucks just to maintain a product that yields pennies in profit. So how is it mathematically possible that Amazon is aggressively expanding into the two worst margin categories in retail history while simultaneously expanding their overall operating margin to near 8%? It defies the gravity of retail economics.
To understand how they are defying that gravity, you have to look at the massive structural overhaul they have executed within their fulfillment network over the last 36 months.
The regionalization.
Yes. It comes down to cracking the most difficult metric in logistics, which is density. Amazon has effectively solved the density equation on a national scale.
Okay, we hear the word density thrown around like a corporate buzzword all the time. But what does cracking the density code actually look like on the physical ground? How does it offset the massive cost of cold chain logistics for a $4 bunch of bananas?
Well, we have to contrast their current model with how they used to operate. Historically, Amazon relied on a national hub-and-spoke model. If you ordered that $4 spatula in Seattle, and the nearest inventory was in a massive fulfillment center in Ohio, Amazon would eat the cost of putting that spatula on an airplane to get it to you in 2 days.
Which is insane when you think about it.
The transportation costs were exorbitant. But a few years ago, they completely redesigned the network, decentralizing it into 8 distinct, self-sufficient regional nodes.
So breaking the country into 8 chunks.
Exactly. The goal was to ensure that the vast majority of items ordered by customer were already geographically located within their specific region before the order was even placed, utilizing advanced predictive AI.
So they basically eliminated the airplane from the equation for the majority of standard orders.
Precisely. But they have now taken that regionalization strategy a step further by retrofitting their hyperlocal same-day facilities. They have successfully expanded this specialized same-day perishable capability to 2,300 cities across the country.
Wait, 2,300 cities.
Yeah.
So in 2,300 cities, a customer can get a fresh banana delivered in hours.
Yes. And here is where the density math works in their favor. Because these specific same-day facilities are located so incredibly close to the dense urban and suburban consumer bases, and because they are aggregating so much daily order volume, the fundamental cost to serve per package plummets.
Ah, I see.
When an Amazon delivery driver navigates a suburban neighborhood, they aren't driving 5 miles to drop off one single package. They are stopping at every third house on the street, dropping off 10 packages in a single block.
Route density.
That is route density. The cost of the driver's time and fuel is amortized across a massive volume of deliveries, drastically lowering the delivery cost per item.
Okay, so predictive regional inventory placement, hyperlocal nodes, and extreme route density lower the transportation costs.
Right.
But what about the labor costs inside the warehouse? Because packing a $10 order of miscellaneous cheap items requires a lot of human hands.
That is where the robotics division fundamentally alters the cost structure.
Oh.
Yeah. They aren't just adding conveyor belts. They are deploying highly advanced AI-driven automation. Management explicitly stated they plan to more than double their fleet of advanced robotic arms, specifically models named Cardinal and Sparrow, across their network by the end of 2026.
Walk us through how Cardinal and Sparrow actually function. What makes them different from, say, a standard industrial robot in a car factory?
Well, a robot in an automotive plant performs one highly repetitive motion, like welding a specific joint on a chassis that is always in the exact same position. It's programmed blindly.
Right, it just does the same thing over and over.
Amazon's logistics challenge is infinitely more complex. A robotic arm in a fulfillment center has to look into a bin containing hundreds of entirely different, randomly assorted items.
Like a book, a plush toy, a bottle of shampoo.
Exactly, or a blister pack of batteries. It has to use advanced computer vision powered by the AI models we discussed earlier to instantly identify the specific item needed for an order, calculate its dimensions and weight, determine the optimal grasp point, and then physically retrieve it without damaging it.
I've actually seen footage of the Sparrow robot. It uses a combination of custom suction cups and mechanical grippers to handle oddly shaped items that traditional robots can't grasp. It's wild to watch.
Exactly. And by deploying Cardinal and Sparrow at scale, Amazon is drastically reducing the number of human touches required per package.
Which cuts labor costs.
Exactly. The robots handle the identification, the picking, and the preliminary sorting. This dramatically accelerates the consolidation of complex orders, like a grocery order mixed with a $10 haul item. And it reduces the labor cost per unit to the point where those previously unprofitable categories become accretive to the bottom line.
Okay, so the combination of route density and robotic automation explains how they can profitably sell cheap goods, but there is a second, arguably much more massive macroeconomic shift happening within their logistics business, and it revolves around something called Amazon Supply Chain Services.
Right.
This was only mentioned briefly on the call, but it feels like it has the potential to fundamentally alter global commerce.
I would argue it is the most consequential strategic move the company has made since they launched AWS in 2006.
That is a massive statement.
I stand by it. Amazon realized that by investing hundreds of billions of dollars over 2 decades, they have constructed the most efficient, technologically advanced, and dense physical logistics network on the planet.
Undeniably.
And they had a strategic epiphany. They said, why restrict this incredible infrastructure solely to items purchased on Amazon.com? Why not open the network and rent it out to the rest of the world?
It's the exact same playbook they used for AWS, but applied to physical items instead of digital data.
Exactly.
I mean, they built internal server capacity for their retail website, realized they were great at it, and rented the excess compute to other companies, and now they're doing the exact same thing with their trucks, cargo ships, and robotic warehouses.
The scale of the ambition is just breathtaking. Amazon Supply Chain Services allows any external business to utilize Amazon's global logistics network to move, store, and deliver goods entirely independent of the Amazon.com storefront.
It's end-to-end.
Yes, they're offering end-to-end management, from picking up raw materials at a factory in Asia, handling the ocean freight, managing customs clearance, storing it in regional distribution centers, and executing the final mile delivery.
And they name-dropped some heavy hitters.
They specifically name-dropped massive global conglomerates like Procter & Gamble and 3M as early adopters of this service.
Let's pause and think about the implications of that. Amazon is now actively moving raw materials and industrial components for a massive manufacturing giant like 3M.
Let that sink in.
They have officially transitioned from being an e-commerce retailer to operating as a full-scale third-party logistics provider, or 3PL. They are directly competing with global freight monoliths like FedEx, UPS, and Maersk.
And they have a massive structural advantage over those legacy carriers.
Because of the density.
Yes, because their network was purpose-built from the ground up to handle high-velocity individual unit e-commerce, whereas legacy carriers were originally built to move large pallets. By opening this network to third parties, Amazon has executed a masterstroke of capital allocation.
Turning a cost into a profit.
Exactly. They have taken their single largest internal cost center, the immense financial burden of moving physical goods around the world, and successfully transformed it into a high-margin, profit-generating service.
So 3M pays Amazon to move their freight, and that revenue actively subsidizes the cost of Amazon delivering that $4 spatula to my door.
This is the ultimate mechanism behind their expanding 8% margin.
That is a phenomenal breakdown of their physical moat. You build the infrastructure for yourself to achieve unprecedented scale, and then you rent that scale out at a premium to your competitors.
It's brilliant.
It is. But building and maintaining that dual-pronged infrastructure, both the global physical logistics footprint and the digital AI cloud network, brings us to the most contentious, heavily debated portion of the earnings call.
The CapEx guidance.
The management guidance, and what I can only describe as severe CapEx sticker shock.
Sticker shock is putting it mildly. When the CFO detailed the projected capital expenditure numbers for the upcoming years, the reaction from Wall Street analysts was immediate and honestly palpable.
Right.
It completely hijacked the narrative of the call for several minutes.
We need to lay these numbers out clearly so you, the listener, can understand why the institutional investors initially panicked.
Let's do it.
Amazon aggressively raised its cash CapEx guidance for 2026. Now, CapEx, capital expenditure, is the hard cash a company spends to acquire, upgrade, and maintain physical assets. For Amazon, this primarily means buying specialized servers and building massive data centers.
Right.
They raised their projected 2026 spend from an already massive $200 billion to a staggering $220 billion.
A $20 billion unanticipated increase.
In planned spending, which management attributed to structurally higher memory component costs and the seemingly insatiable enterprise demand for generative AI capacity.
$220 billion in cash expenditure in a single year is a nearly unfathomable sum of money. To put that in perspective, there are only a handful of entire national economies that have a GDP higher than what Amazon is spending on computer chips and concrete this year.
And management didn't try to sugarcoat it either.
No, they didn't.
They flat out told analysts, even at this $220 billion spending level, we are structurally constrained. We still will not have enough physical capacity online to fully meet the projected demand from our customers in 2026 or 2027.
Which is just a wild statement to make when you're spending that much money.
Right. And to make matters worse for the jittery short-term investor, management paired this massive spending announcement with forward revenue guidance for Q3 Q3 that looked incredibly soft.
The juxtaposition of those two data points is exactly what caused the immediate market anxiety.
Right. They guided Q3 net sales to come in somewhere between $197 billion and $202 billion. Now remember, they just officially posted $200.6 billion for Q2.
So if they hit the midpoint of their Q3 guidance, it implies that sequential quarter-over-quarter revenue growth is basically flatlining,
Or potentially even decelerating slightly.
which naturally leads to the overarching question for anyone holding the stock.
Exactly. What does this all fundamentally mean? If I'm a retail investor looking at these headlines, I see a company announcing a $220 billion shopping spree, openly admitting that internal costs for components are rising, and simultaneously predicting a stall in top-line sales growth for the immediate next quarter.
It looks bad on the surface.
The visceral reaction is to assume the growth engine is sputtering under the weight of its own infrastructure costs. I mean, should an investor be hitting the sell button right now to lock in gains before this massive spending compresses the margins?
This specific scenario highlights why retail investors must learn to translate Wall Street headlines into underlying business fundamentals.
So sell or hold?
My definitive short answer is absolutely do not hit the sell button based on the surface level reading of those two data points. Because if we actually analyze the mechanics of what is happening, both the apparent slowdown in revenue and the massive shopping spree in CapEx are actually lagging indicators of immense structural strength.
Okay, I need you to calm my panicked investor nerves right now. Let's tackle the Q3 revenue slowdown first. How can a flatlining quarter-over-quarter revenue projection possibly be interpreted as a sign of strength?
Because the deceleration is a mathematical illusion created entirely by the calendar.
The calendar.
Yes. It has nothing to do with consumer demand and everything to do with the specific timing of their flagship retail event, Prime Day.
Ah, the Prime Day calendar shift. This trips up analysts every few years.
It really does. And management went out of their way to clarify it. In 2025, Prime Day occurred entirely within the bounds of the third fiscal quarter. In 2026, for logistical reasons, they shifted the dates of Prime Day, so the entire event fell into the second fiscal quarter.
Let me trace the math on that. So Q2 of 2026 received a massive multi-billion-dollar injection of concentrated Prime Day sales that Q2 of 2025 simply didn't have.
Correct.
Conversely, Q3 of 2026 is going to completely lack that Prime Day revenue injection, whereas the comparable Q3 of 2025 benefited massively from it.
That is the dynamic perfectly explained.
So it's an apples to oranges comparison.
Exactly. When automated trading algorithms and superficial analysts compare the growth rates year over year, they are erroneously comparing a standard non-Prime Day quarter in 2026 to an artificially inflated Prime Day quarter in 2025.
Wow.
The CFO explicitly quantified this anomaly, noting that the calendar shift alone accounts for a negative 400 basis point swing in the reported Q3 growth rate.
Okay, for those keeping track at home, 400 basis points equals a 4% drag on the total recorded revenue growth rate, driven entirely by moving a manufactured retail holiday forward by a few weeks. It has zero reflection on the health of the consumer.
Precisely. The CFO noted that if you normalize the data, if you completely remove the Prime Day revenue spikes from both 2025 and 2026, and just look at the baseline, day-to-day purchasing behavior, underlying customer engagement, and unit volume trends are actually accelerating heading into Q3.
The reported deceleration is a complete mirage.
A total mirage.
Okay, the revenue mirage makes perfect logical sense. I can discount the Q3 softness. But you cannot tell me that a $220 billion cash outlay is a mirage.
No, that is very real.
That is real, tangible cash leaving the corporate balance sheet. As an investor, how do you justify that level of extreme capital expenditure without destroying the company's long-term return on invested capital?
To justify it, you have to dissect the masterclass that Andy Jassy delivered on the call regarding the fundamental economics of cloud computing and the life cycle of capital assets.
It was a great segment.
This specific segment of the call was arguably the most important 5 minutes for long-term investors to absorb. He didn't just apologize for the $220 billion. He broke it down into its component parts and meticulously explained why the long-term return on that specific investment is a near mathematical certainty.
Take us deeply into that masterclass. It's just setting piles of money on fire to stockpile computer chips in a panic.
Right. Well, the first critical step Jassy took was to bifurcate the total spend. That $220 billion is not a monolithic expense.
It's broken up.
Yes. It is split into two entirely different categories of physical assets, which possess completely different economic life cycles and depreciation schedules. Servers and networking equipment on one side, and physical data center infrastructure on the other.
Let's start with the servers. This is the actual silicon, the Trainium chips, the NVIDIA GPUs, the Graviton CPUs sitting on the racks processing the AI models.
Right. Servers operate on a relatively short, highly visible capital cycle. Jassy emphasized that Amazon does not buy servers speculatively.
They don't just buy them to have them.
No. They only execute purchase orders for servers a few months before they're physically required to go online. They have absolute contractual visibility into customer demand. If the enterprise demand isn't there, Amazon simply does not buy the server.
That's a highly disciplined, just-in-time capital expenditure model.
It is.
So they aren't out there building a speculative field of dreams, blindly hoping that AI startups will eventually rent the capacity. They are specifically buying these servers to fulfill that $496 billion legally committed backlog we discussed earlier.
Exactly.
Yeah.
They are buying hardware to service guaranteed contracts. Now, here is where the unit economics become highly favorable. Jassy walked through the math.
Walk us through it.
Historically, it takes Amazon slightly less than 3 years of rental revenue to fully break even on the initial capital cost of a server. However, through rigorous operational engineering, that specific server has a proven, useful revenue-generating life of at least 5 to 6 years.
Okay, let me ensure I am mapping this financial timeline correctly. They spend the cash to buy an AI server in year 0.
Right.
By the end of year 3, the customer payments have completely covered the purchase price of the hardware, plus the operational costs.
Yes.
But the server doesn't get thrown away. It keeps running, processing workloads, and generating monthly revenue for another 2 to 3 years after it is fully paid off.
Yes. And those subsequent years, years 4, 5, and 6, represent pure, unadulterated free cash flow dropping straight to the bottom line.
Wow.
The capital depreciation schedule is complete, but the revenue stream continues unabated.
That is a money printer.
Furthermore, Jassy noted that AWS has a phenomenal track record of utilizing advanced software optimization and mechanical engineering to extend the useful life of these servers even further than initially projected.
So pushing that break-even point even earlier.
Right, constantly pushing the break-even point earlier and stretching the highly profitable tail of the asset further out. And crucially, most of their current AI capacity is being secured by customers on massive 5-year non-cancelable contracts, essentially guaranteeing the full lifecycle return.
Okay, when you lay out the timeline like that, the return on invested capital for the servers is incredibly robust and de-risked.
It is.
But that only accounts for a portion of the spend. What about the other massive chunk of the CapEx?
Right.
The physical data centers themselves, the pouring of the concrete, the installation of the massive industrial cooling systems, the routing of gigawatts of power from the municipal grid.
The physical infrastructure is where the true, insurmountable, long-term competitive moat is built. But it requires an entirely different financial perspective.
Because it takes longer to build.
Exactly. Data center capital must be deployed starting 2 to 3 years before you can even plug a single revenue-generating server in.
Yeah.
It requires immense, heavy, upfront startup capital. You have to navigate local zoning laws to secure massive tracts of land, physically construct the highly specialized reinforced shell of the building, and negotiate with utility companies to route dedicated, high-voltage power substations.
Which creates a massive short-term headwind for the company's free cash flow metrics. I mean, you are spending billions of dollars in year -2, and you are receiving absolutely zero revenue from that specific building until year 0. Wall Street famously hates short-term cash flow compression.
Wall Street's myopia is the retail investor's advantage. Because while the startup costs are painful, once that physical data center finally comes online, it possesses a useful revenue-generating life of 30 plus years.
30 years, wow. That is a generational asset.
It is. So think about how that 30-year physical life cycle interacts with the 5-year server life cycle we just discussed.
Oh, okay.
If a server lasts 5 years, a 30-year data center will house roughly 5 or 6 sequential generations of servers over its lifespan.
Oh, I see the compounding leverage now. That is fascinating.
The leverage is astronomical. For the first generation of servers you install, the economics are solid, but they are burdened by the need to slowly amortize the massive upfront cost of the concrete and the power grid.
Right.
But for the second, third, fourth, and fifth generations of servers that you eventually plug into that exact same building over the next 3 decades, the unit economics become absolutely astounding.
Because you don't have to repeat the multi-billion-dollar upfront data center investment.
The building is completely paid for, the power lines are already active, the cooling systems are functioning.
So the incremental cost to deploy the next generation of AI chips plummets, while the revenue generated by those increasingly powerful chips skyrockets.
You've got it.
In the short term, yes, looking at a spreadsheet, it looks like a cash incinerator because Amazon is currently building dozens of these massive 30-year structures simultaneously across the globe to capture the AI demand wave.
Right.
But once that initial wave of infrastructure officially comes online, the revenue growth will radically and permanently outpace the incremental CapEx growth required to maintain it.
Exactly. And Jassy pointed out to the analysts that we have collectively seen this exact financial movie play out before.
When was that?
We lived through this during the initial explosive era of cloud computing between 2010 and 2015, when AWS was first scaling globally.
Oh, right.
During that period, Amazon took massive, heavily criticized hits to their free cash flow to build the initial foundational data centers. Wall Street panicked, analysts downgraded the stock, and commentators claimed they were destroying shareholder value.
The same old story.
And then, a few years later, as those data centers matured and housed subsequent generations of servers, AWS emerged as the most profitable, dominant economic engine in the history of the technology sector.
The narrative arc is identical.
The only material difference this time around is the sheer velocity and the time horizon.
Right, because AI is moving faster.
Much faster. The enterprise demand curve for generative AI is building significantly faster and much more vertically than the initial demand for core cloud computing did a decade ago. It requires a more violent upfront capital deployment.
Makes sense.
But the underlying margin structure and the proven capital return models for AI infrastructure are tracking identically to, and in some metrics, slightly ahead of what Amazon historically achieved with their core cloud business.
So when Andy Jassy looks analysts in the eye and says he has a clear mathematical line of sight to strong financial returns on a $220 billion capital expenditure, it isn't just standard CEO hubris or blind optimism.
Not at all.
It is a verifiable mathematical certainty based entirely on the hard depreciation schedules of the physical assets and the ironclad length of the contracts they're currently signing.
Correct. As long as the underlying enterprise demand exists to fill those servers, and a legally binding $500 billion backlog heavily suggests that it does do. Deploying this CapEx is fundamentally the safest, most accretive bet the management team can possibly make for the long-term health of the company.
Which really brings us to the culmination of this entire deep dive. We've set out to translate the noise and provide an actionable perspective for you, the retail investor.
And we've covered a lot of ground.
We have systematically gone through the staggering headline revenue numbers. We've stripped out the derivative accounting quirks to reveal the true operational margins. We've explored the strategic brilliance of their multi-layered model-agnostic AI stack.
Yep.
We've analyzed how advanced robotics and regional density are turning the brutal logistics sector into a high-margin supply chain service. And we've broken down the generational math behind the $220 billion data center CapEx. So, if you have to synthesize all of these complex interconnected data points for the listener today, what is your definitive talk tickers verdict on Amazon coming out of this Q2 2026 earnings call?
My definitive verdict is highly unequivocally bullish.
Bullish.
Very. When you actively cut through the superficial noise of the Prime Day calendar shift and you move past the initial shock value of the CapEx figures, you are looking at an incredibly rare phenomenon.
Much is.
A massive, mature conglomerate operating at peak, compounding efficiency across multiple, distinct, industry-dominating business lines.
It's firing on all cylinders.
It is. You have a company posting 43% true operating income growth at scale. You have an AWS segment sitting on a nearly $500 billion backlog, successfully and aggressively navigating the transition from the legacy cloud era to the generative AI era, all while actively expanding its operating margin to an astonishing 39%.
The 39% is still blowing my mind.
Right. And then you have a physical retail arm that is not only successfully penetrating notoriously difficult low-margin sectors like perishable grocery and ultra-low-cost goods, but is actively expanding its profitability while doing so, thanks to relentless robotic automation.
Sparrow and Cardinal pulling their weight.
Exactly. And perhaps most impressively, from a macroeconomic standpoint, they are successfully transforming their logistics network, historically their biggest financial burden, into a highly lucrative global third-party service.
The 3M deal.
Yeah. The superficially soft Q3 guidance is just temporal noise masking a foundation of absolute structural strength. They are aggressively investing $220 billion into the future today, precisely because the future is already knocking on their door with cash in hand, demanding capacity.
That is a powerful data-backed summary. They are currently dominating the digital infrastructure of the global economy through AWS and AI, and they are rapidly moving to dominate the physical infrastructure of global trade through supply chain services.
They're an empire.
But before we wrap this deep dive up, I want to leave you, the listener, with one final, deeply provocative thought to ponder. Because buried at the very end of this earnings call transcript, past the hype of generative AI and the debates over retail margins, was a brief, almost casual update on a massive internal initiative called Project Kuiper.
Ah, yes. The Low Earth Orbit Satellite Initiative. It often gets lost in the shadow of AWS.
Jesse casually mentioned to an analyst that Amazon now currently has nearly 400 specialized communications satellites successfully deployed in orbit. 400. More importantly, they are officially launching their initial commercial satellite internet service later this year. They noted they have already secured highly meaningful multi-million-dollar revenue commitments from major enterprise clients, international government agencies, and global telecom partnerships to extend this high-speed, low-latency network across the globe.
It is their direct, heavily capitalized competitor to SpaceX's Starlink network.
Exactly. But I want you to think about what the successful deployment of a global satellite internet network means in the context of everything we have just spent the last hour dissecting.
It ties everything together.
We have marveled at how Amazon completely dominates the digital storefront where you purchase physical goods. We've explored how they dominate the invisible cloud infrastructure where your favorite applications live. We've analyzed the AI agents that are beginning to autonomously manage your corporate workflows. And we've detailed the physical trucks and robotic warehouses that deliver materials to your door.
Right.
Now, I want you to mull this scenario over. What happens to the valuation, the structural power, and the inescapable gravity of this company when Amazon isn't just your retail store, your cloud provider, your logistics partner, and your AI assistant, but literally becomes the global internet service provider?
When they own the pipe.
What happens when Amazon owns the literal physical space-based connection that pipes consumers directly into their proprietary ecosystem from any square inch of the earth, entirely bypassing legacy telecom monopolies?
That is a level of end-to-end, planetary-scale vertical integration that the global economy has not witnessed in over a century.
Exactly. And if Kuiper succeeds, I would argue that is where the real terrifying acceleration of this company actually begins.
It is a profound structural shift to consider.
Yeah.
It moves them from being a participant on the internet to being the infrastructure of the internet itself.
And on that massive planetary note, that's all we have for you on this deep dive. Keep a close eye on those tickers, ignore the short-term noise, and we will see you next time.